Typically, most sell days will create the high of the day from the central bank dealer's range up to 3 standard deviations. Most buy days will create the low of the day from the central bank dealer's range down to the 3rd standard deviation. Ideally, sell days create the high of the day no more than 2 standard deviations above the central bank dealer's range, many times just 1 standard deviation. Ideal buy days will create the low of the day no less than 2 standard deviations below the central bank dealer's range. And ideally, many times you'll see it just go 1 standard deviation below the central bank dealer's range, creating the low of the day. 4 standard deviations above for a high of the day is going to be on the heels of a very high impact news event for the session in London. Same thing is said on buy days. If it trades down to 4 standard deviations, usually it's going to be very high impactful news, or price can come down or go up to the 4th standard deviation to create a New York session market reversal profile. Okay, dealing specifics with the central bank dealer's range. The time period that frames the central bank dealer's range is 2 p.m. to 8 p.m. New York time. The ideal range is less than 40 pips. Preferably, the range should be no more than 20 to 30 pips in total range, high to low. So what are we saying here? Between 2 p.m. and 8 p.m. New York time, regardless of where you live globally, you need to find where your price charts indicate what would be seen as the candle that starts the 2 p.m. and 8 p.m. times in New York time. So for completeness sake and the sake of avoiding all confusion, like everything else I always teach, find out what New York time is where you're at geographically. Then find out what that looks like in your platform for your charts and delineate that with a vertical line with 2 p.m. New York and 8 p.m. New York. Between those two time windows, the highest high and the lowest low ideally should be less than 40 pips, preferably 20 to 30 pips total. Ranges larger than 30 pips can tend to be unfruitful for projections. Now we can use the range in pips by calibration from high to low or using the wicks, or alternatively, we can use the range in the highest body and the lowest body as well, whatever the highest closing or open price is, and whatever the lowest close or open is in between 8 p.m. and 2 p.m. New York time. Now, obviously, we need to know directional bias for this to be of any assistance to us, so it has to be used in conjunction for our projections to work. The central bank dealer's range strength is aiding in the low of the day or high of the day selection. So the central bank dealer's range main focus is to help you find the high or low of the day in respective bullish or bearish days. In other words, if we're bullish on the market as a whole, or if we're looking for one shot, one kill for the week that's predominantly expected to go up for a Friday close higher than where it opened up on Sunday. For instance, if we're looking for one shot, one kill in a bullish week, we're going to be looking primarily for low of the day in London each day, Tuesday, Wednesday, and Thursday, preferably those days, but it could occur on Monday as well. But we're looking for the low of the day to form in London in that criteria. But just because we're looking for the low to form and be a bullish close every single day doesn't mean this highest probability setup, and we can use the central bank dealer's range to help frame that context, as we'll teach in this lesson here. But we're using wicks in this example here. So every one of these blue boxes represents the central bank dealer's range for that respective day. Now this chart represents the central bank dealer's range with using the bodies. Now I will have to admit to you, I like to use the bodies predominantly because the wicks are always going to show erroneous price because of your dealing spread through your broker. Everyone's going to have a disparity between their high and their low on every candle. It's never going to agree. So what I use is the bulk of the trading, which is the body. That, in my opinion, and there's no real panacea, be-all, end-all answer for this, but my studies over the last 2 decades is if we focus primarily on the bodies of the candles, we're going to get more closer to what smart money's doing in relative terms than if we use just the wicks. Now, we can get a lot of feedback in terms of what retail's doing if we study wicks, but if we study the bodies of the candles and we frame our ranges with that, we'll get more clear pictures about what the institutional accumulation distribution ranges are going to be when we use the central bank dealers range. So as you can see here, each one of these ranges has its respective ranges in terms of pips. The first is 13 pips, the next is 58 pips, the next is 19, and the last in this example is 16 pips in range. So using the bodies, we're going to focus primarily on that. Now, before I go into greater detail, I want you to think about, just because I like using the bodies and I think it's got the most advantage, we still have to look at the ranges with the wicks included. Okay, so let's take a closer look at each example here. For this first one, we have replicated that central bank dealers range, the little blue shaded area, and we duplicated that range and projected up one standard deviation. That's what the 1 SD stands for. So one standard deviation and second standard deviation, which is just basically central bank dealers range, total pip range, or in that case 13 pips. We added 13 pips more and then added 13 pips more for a total standard deviation of 2. Notice how it takes you right to the high of the day formed in London that particular session immediately after the central bank dealers range closes. So in other words, at 8 p.m. starting the Asian range, project that range that we created for central bank dealers range, 2 standard deviations up. That gives us the projected London high. Now, it does not mean it's going to call it to the pip. It might go a little bit above it. It might fall a little short of it, but it gives us a range to look for. The next one in our example here, the range is 58 pips. Now, this is too large. Our rules state that we want to have 40 pips or less, ideally 20 to 30 pips. So this particular trading day, we have to allow the market to do whatever it wants to do. If we're going to scalp, that's another thing. But for day trading, we can't use this criteria because it's too large of a central bank dealers range, and this is not what I taught in the free teaching on my YouTube channel. But when you're using central bank dealers range projections, highs and lows, the criteria is 20 to 30 is ideal in terms of pips. It has to be less than 40 generally, but ideal ranges are 20 to 30 pips high. And the reason why is if the average daily range of the candle for the daily chart that you're trading is typically around 100 pips, let's say. Now, they're not always 100 pips, but I like to use as a ballpark figure, general rule of thumb. If we have 100 pips, 1/3 of that is around 33 pips. So that's why I give about 20 to 30 pips. Ideal scenario, you want to be less than 40 pips for that reason. So for Power 3 concept to unfold, if we're bullish, we're looking for the opening price and then the market to trade down 20 to 30 pips. Ideally, no more than 33 pips. If it trades beyond that, we don't want to see it trade more than 40 pips. It doesn't mean it can't, but ideal scenarios, the drop down from the opening price on accumulation days where the low of the day is formed and we have a higher close, bullish. We're looking for that 20 to 30 pip drop down, and we can use the central bank dealers range to confirm that with other things that we'll teach in the next lesson. The next example here, we have one standard deviation projected below it, and you can see we just about hit that, but it was definitely inside the first standard deviation, creating the low of the day, and price trades up aggressively. The next example, we have one standard deviation projected below, and a second standard deviation projected below. So now we have 2 standard deviations below the central bank dealers range for this particular day, and it takes us right down to the low of the day. It was only off by 1 pip. It went below 1 pip, and then we saw the low that they formed in London. Looking at this, obviously, it looks like cherry picking hindsight and all that business. But I want you to take in consideration, when we look at price, we have to have a bias. What do we think price is going to do? Is price going to go higher or lower over the next 2 or 3 days? What's the price most likely going to do over the course of this present week or next week? Is it going to go higher or is it going to go lower? Where are we at seasonally? Are we looking for bullish prices or lower prices? Where are we at quarterly? Are we in a quarterly shift that is underway that's still unfolding with bullish prices, with premium PD arrays that haven't been met yet? If that's the case, then we could be looking for scenarios to look for buys. So we're looking at discount PD arrays. We're looking at reasons to suggest buying in a discount range. So our PD array matrix is going to help us look for reasons to build ideas that are bullish. If we look for those ideas with the central bank dealers range in conjunction with those, it'll help us narrow down with time of day, London open. It'll help us frame ideal entry points. So if we look at the daily chart and we see price trading up at a premium PD array and markets are bearish, we're looking for lower prices for a one-shot, one-kill scenario, looking for a lower close week. We could be looking for 1, 2, or 3 standard deviations moved higher when the central bank dealers range is around 20 to 30 pips, ideally. And if we get that projection up into London, we have a great deal of advantage on our side that we're probably going to get the high of the day in the London session. Okay, so let's go out to a daily chart. And I'm going to ask you, what do you see here? Okay, I'm drawing your attention to a specific level with that little trend line, blue line. And that's the segment of price action that we're looking at in terms of those examples. And I'm going to highlight that little area in this white box. Okay, so we're looking at this whole entire reference point here. And again, I'm going to counsel you to go back to the time when we were talking about the cable and analysis and all of the charts that were shared. Okay, go back and look at that. So none of this stuff is cherry picking, okay? So what we're doing is we're looking at the marketplace using the PD array matrix, and we're blending it with time and price theory. So we're looking at IPTA data ranges. We're looking at PD array matrix. Are we in a premium or discount? The market trades down in the lower range of that white rectangle until it hits a bullish order block. What I've done there is I've taken the Sunday candle and the Monday candle, blending this small little Sunday candle and Monday candle into one candle, blending the two bodies together. And I got a measurement of that, and I projected it across the chart. And you can actually go back and look at your notes and look at the forum. And I've counseled you to download the charts every day. I do them because you can keep track and see that I don't make any changes. I don't go back and re-edit them. You get them as I see it, so that way you can compare what I'm explaining to you here was exactly outlined in terms of the PD arrays specifically. I even tell you that's a mean threshold of a bullish order block there. So price hits that level, creates the first of 3 up candles. And now we're going to go into those examples and break it down. Okay, folks. Okay, here we are. We're at that point where this stuff starts to get really, really interesting. So when we look at these examples, okay, this is where the price has traded up into a premium on the daily chart. And we did our standard deviations, okay, and we see price that was on a daily chart in a premium at this time. We have a bullish candle right for the down move here. That gives us a bearish order block. That low comes in at 125.93. The high comes in at 125.97. So it trades up into the body of the bearish order block. Standard deviation of 2. Price extends up to the standard deviation, right to the pip, and starts to trade off for the rest of the day. When we have the standard deviation arrived at based on a PD array. In other words, we're looking at a premium PD array, bearish order block, price in a daily premium, hits it in London, we have a protractionary state in the marketplace, Judas swing in London, goes right to the pip and trades lower. The question is how low will it go? Well, you have to look at the range that was created by the central bank dealer's range protractionary state. In other words, how much of a standard deviation did we see? Because that becomes the known range to work with, and it becomes our multiplier as well. So when the market looks to fill the numbers, and I'll tell you what that means when we get to it, we use this reference point here. So it has to actually, the actual standard deviation range that we use for the central bank dealer's range and all the standard deviations it uses to make the high or low of the day in London, that becomes your measurement. Okay, so what we have here is the market showing us a midnight in New York candle, vertical line, and then 1800 or 2 o'clock in the afternoon, New York time. And again, each day, midnight New York, 2 o'clock in the afternoon, midnight New York, 2 o'clock in the afternoon, midnight New York, 2 o'clock in the afternoon. Okay, and I'm going to give you the London kill zone reference points now. And this is that weekly, the daily premium PD array up here. So price trades up into it and starts to sell off. So in this time element here, this gives us our London close time of the day. So this candle here starts it. This is the middle of the London kill zone close. And then we have this candle here, right there, that creates the projected London close time window. But then we have ultimately 2 o'clock where we actually see the close of our highest point. In other words, usually the higher low, even on a really long-winded trending day, 2 o'clock usually caps the higher low of the day. If we continue through London close kill zone, or basically if we go past noon New York time, we look for it to go to 2 o'clock and dribble down or run up until that specific time of the day. So all of these days, we don't have anything on this day here because the central bank dealer's range was 58 pips, regardless if we used the wicks as the high and low or if we use the bodies high and low. It doesn't make a difference. The point is it's still too much of a central bank dealer's range to use for our projections in here. So we have to skip on this day here, but we use other tools, which we'll explain in a moment. The daily bullish order block, price trades down into that on this big central bank dealer's range day. Trades down into the bullish order block here, and then finds momentum to trade higher. And then we have the scenario where we'd expect to see price move higher on a bullish discount PD array. And the same thing here, continuing up, looking to close in our gaps over here, which we'll look at in a moment. So when we have this range here, price moves into a protractionary state up to standard deviations. What you do is you take that range, and yes, I do all this by hand. Okay, so we have our range, and you just lay that on the bottom of the central bank dealer's range, and you start layering them down. You hold down Control, drag your image away, click on it, and drag away with the Control button held down. Right there. Okay, so we have to blend two things now, time and price theory. So we're looking for this whole range of 2 standard deviations projected from the central bank dealer's range low, because it's going to be a bearish day. So we have 1 standard deviation of the total standard deviations used for the central bank dealer's range to call the high of the day. So we have 1 of those standard deviations, 2 of those standard deviations, 3 of those standard deviations. Why am I doing 3? Is because price kept going lower, 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 lower until we get to the time of day right in here. Okay, so I'm going to draw a vertical line delineating the beginning and the end of the London kill zone, for the London close rather. So this candle closes it at noon, This is 11, and it starts as early as 10 o'clock in New York time. Okay, and we have this projected low. So I'm going to use this line here. And yes, the charts will look a little bit busy for a moment. And we'll project this out in time. Okay, so we could take profit here on this day. The low comes in at 124.76. The close on that candle stops right at 2 standard deviations of the central bank dealers range. Right there, you see that? Boom, hits it. Okay, yes, it wicks down a little bit more, and I'll let you see it. A little bit more than that, but not by much. Okay, and now we're going to look at the 1800, which is the cap of the day. There's the low, and there's our projected low right here. 124.40. We called 124.41, so I was off by 1 pip. Okay, so time-wise, we looked for it to occur here. It just fell a little bit short, but it had to go one more standard deviation because it kept drifting lower. So there's nothing wrong with just taking profits here and leaving something on for the rest of the day, because there's a discount PD array of a bullish order block down here that we saw on the previous slide. That would be your objective. But you can take profits time of day wise here with 2 standard deviations of the central bank dealers range, 2 standard deviations used to make the high of the day. So again, in summary, we're taking the total range used of all the standard deviations, 1, 2, 3, counting the central bank dealers range always. So we have 3 of them. So we get a mock-up of that range and then project it from the low on sell days. Here's 1, 2, 3, and it gives you the IPTA projected daily range low. Okay, I'm going to take this off. Okay, and we can't do anything with this one here. We'll have to wait, get new information. And the next day here, we have our criteria here where it's a small enough range, the central bank dealers range. We do 1 standard deviation down. Why are we going down 1 standard deviation? Because we have the bullish order blocks in here and an old bullish order block back here. Price trades down into it, clears out even the rejection block, which would be the bodies of the candle, sweeps through that in London. 1 standard deviation, misses it by 2 pips. Okay, so this is going to be a time where you just don't get it exactly, but it's still calling 1 standard deviation. So we get a range, okay, of these 2 together. So what you do, I'll borrow this. Okay, and I'm getting a measurement of that total range. It's almost the same thing, actually. It's pretty interesting. Okay, so we have 1, 2. Okay, 2 projected standard deviations up. That gives us a projected high. And I'm going to tell you why I stopped here before you start thinking, oh, you're cherry picking. Okay, so we have the projected high called here. Notice that this wick right here goes through our projected idea of where price should go. But this one stops right to the pip. Here's our time window when it starts on this candle. So it's a little bit early, 1 hour early, making the, well, not 1 hour early, but in the 9 o'clock hour of New York time, it made the high of the day. Then 10 o'clock, it made this candle's high, 11, and then noon here. Why did it go up to this level here? Forget the time element because you're never going to have that perfectly, but it just gives us a ballpark figure time-wise when to anticipate the move to unfold. But I want you to look back over here. We have a candle. It makes a low, and the close comes off that low by a little bit. Then this candle opens, trades up a little bit. So all of this buy-side delivery vacancy, okay, or void of buy-side delivery, it's only sell-side delivery, begins at this candle's low, okay, at 125.26. So from this candle's high here at 25.03 to this candle's low at 25.26, we have 23 pips of range to close in right up to this point here. So we can look at that like this. Here is the fair value gap that needs to be closed in. It does it right there and goes just a pip or 2 above it. closing in this fair value gap from this high to this low. So it closes that in. So there's a reasonable expectation for us to take profit there because we want to get out early anyway, but that's why it went to that price point using the PD arrays. Okay, so nothing's changed. There's no no hocus pocus. It's all stuff that you've learned, but now we're applying it with a great deal of precision and using time elements. Okay, so we went 2 standard deviations up. If we were to go 3, if we went 3 up, that would took us up to the bearish order block. But we were getting close to the time window. So while we could have expected this to occur, 2 is about right because we're going to close in the fair value gap as we were running up here. And it became late in the day on New York for London close overlap. So that's why we'd expect to see price peter out at that point. Again, here we have 2 standard deviations down. It goes right to the pip. So we get a measurement of this entire range of 2 standard deviations for that particular day. Okay, so we have our range defined. So you have that, 1, and 2. Okay, so we have 2 potential standard deviations up. And also, when price trades down 2 standard deviations, what we're actually seeing is it trades down to another discount PD array, which is these 3 consecutive down candles. All we're going to do is extend this over, and you'll see the overlap. Boom. Okay, so price trades down, hits it. The opening on this candle is 124.36. The low on this candle is 124.36. Precision. 2 standard deviations, okay? And as a general rule of thumb, I like to always throw 2 on just to see what would line up. So on the first one, we see price could reach up to this fair value gap in here. So this candle high and this candle low, we left a little bit of sell side delivery only, so there's a buy side liquidity void that we can see it trade up into. It's more specifically this candle, not this one, I'm sorry, this candle here. So we can look at that, frame that out here. Okay, so on this day, price trades up. Here's the noon close of London. This candle right here trades up, closes in to the bearish order block. It goes inside of the second deviation. So while there still may be some range permitted based on the projections, it's the PD arrays that call the shot. Okay, it's not the magic of these projections. These projections will lead you to an overlap of time and price. So we're looking at the extension of the range, 2 standard deviations, measure that projected above from the consolidation of the central bank dealers range high. We place that on there. 1 standard deviation, that alone would have been enough. And you could have took profits right there. And that would have been fine. And just left that little piece on there for the fair value gap to fill in and let the rest of the people chase that. The second one, you can have a little piece on still. Once it closes in the fair value gap, again, you would take another portion of your trade off and then see if it has any room to trade higher.